Hi everybody, Brian here from quantlabs.net. So in this particular video here on Tuesday, January 9th, we're going to be talking about policy tightening of the Fed as the UK, US are pointing towards financial conditions now, according to Goldman Sachs. This is an article from Reuters. Goldman Sachs financial conditions in the US are looser now when the Reserve started raising rates in 2015. They say that the real interest rates remain negative, and it depends on what level of inflation you're using. Real rates could be as low as negative 0.5%. And then we have here negative real borrowing costs add fuel to markets that are already on fire, limiting the downward pressure on bonds, keeping corporate spreads on the tight side and pushing stocks to newer high after high. And that's what's exactly going on. So just to keep up, I'm using an article, a column actually, from Reuters.com called Policy Tightening, It's Real Rates That Matter for Markets, McGeever. So going back to where I was, when compared with real results, stocks aren't particularly expensive, according to the Bank for International Settlement. Slump in real yields since the crisis means the S&P 500 near 2.5% dividend yield remain tempting to investors, which they are always piling in. So we are hitting the level of some kind of boom time where there's an asset price inflation everywhere, but the consumer price is pretty much nowhere to be seen, which is why central banks feel comfortable tightening policy so slowly. I'm not going to get too much deeper into these articles, but if you are one of my members, the Quant Elite thing, you can definitely get the links there, just so you know. Also, this next article called Financial Times, which is the key one, U.S. Treasury 10-year note yield hit, let me start again. Article called U.S. Treasury 10-year note yield hits 9-month high after BOJ decision. So what happened was the Bank of Japan decision to trim its purchases of longer dated debt, which they've been trying to partially inflate so that they could get their economy going again. Inflation has just been so low for them for so long. We're talking decades, and actually more deflationary condition. Tighter policy from the Federal Reserve, odds that the Fed will lift interest rates by another 0.25% point in March are now at 80%, according to calculations on federal fund contracts. The yield on the 10-year U.S. note, which moves inversely to its price, has climbed to a basis point this year. Selling on Tuesday pushed yields on the 10-year note 3 basis points higher to 2.51%, with yields on longer dated 30-year Treasury raising 4 basis points to 2.86. Some are not convinced. So one person at Citigroup said, pretty spirited domestic foreign policy, foreign real money buying last time yield on 10-year notes hit 2.5% in December. As also with the founder of PIMCO, Bill Grove, says that the bond route has now started. That's what he said earlier today. All right, so another article is this thing called a movement, I can't remember what it's called, a movement index from TD Ameritrade. I'll show you the chart in a minute. Again, this is an article from Bloomberg now. It's love stock investors meant a 9-year rift and embrace the bull. But they're getting kind of too late in the game. Otherwise, patient investors had to deploy capital. Failing to do so puts them in an early performance discrepancy, condition that was difficult to overcome last year. So there's lots of optimism for the Trump tax program in pushing up profit estimates faster than any time in 5 years. Data on anything from manufacturing, employment, housing is breaking the bulls' favor. Nobody seems to mind the S&P index trade for around 23 times earning. So you can see here in this chart, 80% of S&P 500 stocks trade above their 200 moving day average. So they have this thing, these positive equity allocations in December, 11th straight month. Longest buying streak for retail investors since the firm has recorded. So this TD Ameritrade Investment Movement Index, a measure that has tracked client positioning in the market since 2010 to a record for a second month in a row. All because of reaching all-time highs, only to jump the most in 13 months. Rose 2.6%, coming within 0.5%, surpassing roughly a quarter of strategists' price targets. Futures on the S&P rose less than 0.1%. So the S&P has surpassed year-end price target. So now there's animal spirits in the market. Now there's this fear of missing out, FOMO, bears and the bulls, close to the levels that ring alarm bells. I'll talk about that in a minute. The index 30-day relative strength indicator, RSI, on Monday jumped to 74 near the record level last seen before the dot-com bubble. And that's from data Bloomberg, what it shows. So basically it's the equivalent of an RSI. We have an overbought scenario here of over 70%. So we have now broken through that, which are alarm bells saying it's time that the market will start at some point starting to turn. It's making strategists nervous. And last week to cut U.S. stock holdings to a minimum amid concern, investors have already priced in most of the growth. So they are anticipating things will grow, will start to slow down. 19% jump in U.S. equities pushed the S&P 500 23.1 times compared to 21.2 times for the all-country world index. And on it goes. So the other thing that will be affected is gold. When you look at gold here in this article, there are various indicators that are impacted with gold. There was traditional drivers that drove gold. So we find that the positive performance during hiking cycles, we talked about that earlier, with three drivers identified our gold price framework. So this guy's got some framework. But here's his three drivers. Gold will likely sell over the coming quarters even as Fed keeps raising rates. So what are those drivers? Let me just find them here. Driver. So I can't remember what it was. Let me just give me a second here while I find it. Okay, here we go. So in-depth analysis, three main drivers we identified in our model: central bank policy, real interest rates, quantitative easing, longer dated energy prices, which they are anticipating oil will start to go up, and changes in the central bank gold holdings. That's an interesting one. I never would have thought of the gold holdings. Gold prices went down in one instance, essentially flat into and substantially in the remaining two, according to this table. Blah, 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 blah. But I just wanted to show that there is anticipation of gold going up. So again, this article can be found at commoditytrademantra.com. Article is called How Gold Prices Perform During Interest Rates. And they can also be further found in my Elite Payment section or the paywall. Hopefully this will help you out, and we'll talk to you later.